Hey, everybody, welcome back to another session of our podcast. I'm Serge Berger, your host, and today's topic is, I think, one that we hear more and more people thinking about after a very long period of an equity stretch to the upside, US equity stretch to be very specific. And so today's topic is hedging. There's a lot of ways of doing that, and I'm very pleased to say that I've got John McNamara with me from Hedgeye Asset Management. John, thanks for being on the show.
Hey, yeah, great to be with you.
We have spoken before. We talked a little bit off camera before. I gave you some sort of insight of kind of what we're seeing from clients. And there's, kind of a bunch of ways of that's kind of popular right now, at least sort of in mainstream, how to hedge a portfolio. Obviously, we can do that in very sophisticated ways. There's products like buffered ETFs and other ways. And I kind of thought I would just give you sort of the opening volley here to kind of give us your thoughts on all that. And there's two distinct thoughts right now, right, about this whole space. So give us your view, and then I'm sure we'll find other ways to kind of talk about this and tell people, how we can look at this maybe in the best possible way.
Yeah, absolutely. I think that the two distinct trains of thought that you're referencing are, kind of the back and forth, or, maybe not the direct back and forth, but at least the splashy headline pieces out of both, BlackRock and AQR. BlackRock on kind of the raw go-go end of the spectrum, basically saying that, they think that these structured outcome ETFs, they're often referred to as, assets could get to 650 billion by, 2030. And obviously, they have a product set in that space. So I'm sure that they would love to see that. On the flip side, AQR, obviously a very, sophisticated quant manager based out of Greenwich, Connecticut, coming out and saying, hey, these things actually are really not delivering on, what they're promising. And, you effectively can, do the same job by just allocating between, cash and equities, or, treasuries and equities. So certainly, a palpable debate out there going on, and, obviously a space that has seen tremendous growth. I think Bloomberg does a nice job of compiling data specifically on the buffered ETF space. Again, I think they refer to it as the structured outcome space. And, that's gotten up to, basically from almost nothing back, pre-2020 up to about 75 billion, as of current quarter. So, obviously has seen tremendous growth, kind of in addition to that buffered space, if you will. There's the hedged equity space, which, is dominated by JP Morgan. I think between their strategies, they have over, $30 billion. So, there is a tremendous demand out there in this space. And, there has been a lot of money allocated to it. And I think, something that you and I have touched on, previously on separate calls, as well as kind of, before we got on here, is just, hey, if I'm, just a normal guy with an equity portfolio, gal with an equity portfolio, I've done tremendously well. And, I've got really significant gains. The past 15 years have been great. Even, coming out of COVID, the government spending boom that, really put a bid in kind of in all, whether it be real estate, wine, what have you, equities, certainly, this is great. Things are good. And, as I've said to you previously, right, calling tops is not a particularly fun business, or, hasn't been for the 15 years, like we said. I think, you saw Michael Burry just wind down his hedge. He's returning capital. A lot of really smart investors have, flipped their firms into family offices, not so much because, they've been trying to call tops, but, just the investment landscape has changed, and kind of, 7 stocks have really driven all the returns in markets. So, where does it go from here? Where does that take this conversation? I think if you're sitting on, tremendous gains, it is an interesting time to be looking at, maybe deploying some of these, hedging strategies. And I think that is why you've seen this boom in assets in these structured products and hedged equity type products. So,
well, one of the reasons that I wanted to have this discussion, and I thank you again for coming on, because I think, what you guys do is very unique. I wanted to really kind of bring make people think about this, because what you said before, right? So the S&P was up 23, 24% for a couple of years in a row. This year, we're still up nicely. So a lot of the folks that we speak with that have essentially doubled, not quite, but in some cases, they have doubled their money in 3 years. And so what I'm starting to see a little bit more is they're actually, which is a new thought. I haven't heard this for a while, but they're now starting to think of, well, I want to keep my gains, which is a very different thought than we've heard now for a very long time, which is like, how do I get the most potential, leverage to growth stocks? And of course, they got clocked along the way a few times on the trading side, but because they're passively allocated to whatever, right? Some 60-40 thing or something, it hasn't really mattered and dented too much into their, gambling addiction on the trading side. But now they're starting to think about, some of them are starting to think about, what if the S&P were to go 20%, and you have to show it to them because they don't see it otherwise. I can show them the correlation of, let's say, their portfolio to the S&P, which typically 1, or more, like almost every single time. And show them that, listen, if the S&P were to go down 20%, your portfolio is going to do exactly the same thing. It's going to lose $200,000. And then they're like, oh, I don't want to lose $200,000. Well, there are some ways that can maybe be beneficial for something. And just, I'll mention this. This is obviously not advice, just educational, everything we talk about here. So I think it's an important, I'm trying to do an important job here that I see very few people out there doing, trying to get people out, an alternative to actually, hedge their book, if you will, as opposed to just saying, here's the next, AI stock that's going to go to the moon.
Triple levered NVIDIA.
I kick when I see those things. Actually, question for you before we continue. What is thinking in this space? How many institutional side use sort of, buffered products and things? And we should probably talk a little bit about what that is. Do you have any estimate on that? And just, this is kind of a random thought that just came to me because I never really thought about that.
So I would say, on the institutional front, right, that's kind of a dangerous word, the institutional front, because obviously, the institutional front encompasses a lot of folks. So, large scale, RIAs who are allocating to strategies like this, certainly folks who I've spoken to, who are managing, billions, they're allocating to strategies like this. And obviously, for a lot of them, the feedback that we get and, the conversations that we have, if you're a large scale RIA, kind of like, I think you've said previously, hey, I'm trying to, allocate or help my clients allocate, their wealth prudently. I don't necessarily, have time to be going in and adjusting, options positions or what have you, across, many hundreds of accounts. So, the feedback that we get a lot is these buffered ETFs, these hedged equity ETFs, they're great because, I can just buy them in the client portfolio and I know that I'm getting the options exposure in there rather than having to manage it myself. Yep. So, certainly there are, a lot of, sophisticated RIA type institutional investors who are utilizing this stuff. I would say, for the larger scale, pension funds, endowments and such, if they want to do something like this, they would either do it via, an SMA or, potentially hire a manager to, carve out a slice and do it for them. And, certainly there are, platforms like the Goldman Sachs's of the world, or any of the other large kind of where they're, have institutional grade strategies internally that basically are doing this, in an SMA format. Mm-hmm. So, I would say that there, definitely, it has been an institutional adoption. I would say probably more so on, the large A front. And again, kind of just getting into that ease of use where it's like, hey, I have this ticker, I kind of know what I'm getting. But yeah, certainly with the asset growth that I referenced previously of, kind of, pre-2020 from nothing to now, 75 billion. Obviously, that's just on the structured product side. And again, that data from Bloomberg. There has been adoption. So, and, there has been, a large uptick in interest. And I do think it does somewhat play into the conversation that we're kind of having here broadly where, hey, I've done really well in markets. My equity exposure, has been great. To the extent that I'm going to put new capital or deploy new capital in markets, it might be better to look at, rather than just, piling it into the go-go rah-rah, so wealth me. So far, taking an approach of maybe, having a risk management framework, for new allocations. So I think that is certainly what people are thinking.
Yeah. I just remembered we probably define what a buffered ETF is. So, I mean, there's a lot of different things, but I might want to give people just a real quick synopsis of that. Just 2 sentences.
Absolutely. So, buffered, hedged equity. I mean, it's really all kind of the same stuff. I think, the typical, buffer strategy, right, is kind of running long the S&P 500, or at least, this is, the typical the buffered equity strategy. So running long the S&P 500 and then deploying what's referred to as a put spread collar over that. So basically, you have your long position, let's just call it SPY, for example. You have your long position, and then you write an up. That gets you, kind of your on the upside. And then with the proceeds of that call, you buy a put spread. So, you buy a closer to the money put, and then you sell, a lower down out of the money put. So, that gets you, your buffer, if you will. So, you're obviously capped out on the upside in terms of, where you can go. And, we've had plenty of dialogues with clients where it's, I've gotten tapped out, but, I do know where my, downside is. So I'm happy with it. And, basically that put level and that put spread gets you your buffer. Obviously, if the whole put spread ends up in the money, you are going to participate, but, that's what gets strategy. And that's, basically what the incumbent hedged equity and buffered strategies are deploying. Typically the differentiation, the hedge on the hedged equity side, they typically roll on a quarterly, cadence. And then on the buffer side, I think you see, like, they typically have the month in the ticker. I think PJAN is a big one. Yeah. So, PJAN, January is their buffer, January is their options positions. Yep. They roll once a year. So that's kind of the setup on the incumbent.
Yeah. So that's kind of the thing, right? So for those people that have done this before, these are ETFs, and it's a little bit of pain that you have to change the tickers all the time, or sometimes you can, I think there's like fund-to-fund versions of it too. But basically, you can say to yourself, okay, I want to participate to 80% with the S&P. That's another way of doing that. And I'm downside protected for the first 10% or something. And I'm coming up with random numbers, right? So that's kind of the idea. Now there's drawbacks to this that we can get. But, one of the things that I enjoy, and that's really why I wanted to have you on in terms of the alternative to this, because I do want to educate people on different things out there. Now, again, you're obviously on asset management, and there's an ETF out there called KSPY, that you guys run. I would like to just kind of get right to the point and see if you can inform or educate, right? That's what this is about, our audience a little bit. What's the difference between what KSPY does versus what some of these buffered ETFs do? Because there's a lot of different alternatives. And so I just want to make sure people understand the different things.
Yeah. And I think we've done a really good job of setting the stage. I mean, kind of the reason that we, got into that partnership was running, or, helping them manage that particular ETF, was because basically, as I said, kind of my background is in derivatives. I became aware of these, huge trades going up in the options market, started doing a little bit of digging, on, hey, what are these? What is, basically found out it was related to these, hedged equity or buffered strategies, took a look at them and, kind of immediately saw that, hey, they're, not that these are flawed, because certainly they are filling a void, for investors in terms of, having a layer of risk management portfolio, but just, I think a lot of the things that lay over here at Hedgeye are like a better way. I'm trying to find a better way. And, basically taking that back, given my background and, what we have at Hedgeye, I took a look and just said, hey, there has to be a better way to deploy, these types of strategies. What do we have, that could really assist us in doing that? And, if Hedgeye, for those of you who don't, obviously, a research, I think they're best known for their macroeconomic, which is obviously headed up by Keith McCullough, who's the founder and CEO of the firm. The outputs of the macro process, and this is very simplistic, are really the the quad framework, as we refer to it. So, measuring and mapping rates of change of growth and inflation across over 50 economies. That kind of sets us up in terms of like, hey, what do we want to look at from an asset allocation perspective? What's interesting? And then, I like to refer to that as like, hey, that's your map. That's your paper map. It kind of helps you figure out where to go.
Yeah.
And then on, your navigation side or your Waze or your Google Maps or whatever, getting you there in the most optimal way is what we refer to as our price signals. So, these are a proprietary model that was developed by Keith McCullough during his time as a hedge fund manager, which, he then obviously brought over and founded Hedgeye with. These are, levels that are based on price, volume, and volatility.
Yep.
And basically, for us to have an allocation, to something, it has to check both boxes. It has to, work from, the economic data perspective, the quad perspective, as we refer to it. And it also has to check the box on the signal front.
Yep.
So, again, I'm just trying to set the stage for kind of how we build. So this product or, this strategy that we have with Crane Shares particularly focuses on those price signals. So, for deploying the options strategy, that we utilize those we refer to them. So, they're just buy and sell levels that are dictated by that price, volume, and volatility model. So, basically what we do is, we deploy similar strategy to the incumbent hedged equity and buffered products, which is that put spread collar, which we obviously just detailed. We deploy that when the S&P 500 is within, that risk range, as we refer to. And, basically the reason behind utilizing, those risk ranges for, deployment of the option strategy is, it really takes into account what's going on in markets rather than, just saying,
Right.
hey, I'm going to be X plus X minus percent on my options. Like, this is, it's every day the price, volume, and volatility, and it's spitting out, those levels, and just to speak to kind of a marginal level of, if you will, since Hedgeye started publishing those risk ranges back in 2015, the S&P 500 has closed within its daily published risk range 83% of the time. So, again, when we're, the traditional hedged equity buffered put spread collar, that's when we're within those risk ranges. So, given that 83% of the time number, you would expect to see that strategy deployed the majority of the time. Now, where this strategy gets really differentiated versus, the incumbents is when we're above or below, those levels. So, basically put simply, what we're trying to do is, maximize our ability to participate in markets, when the conditions are the most optimal, and minimize, the strategy's participation when, conditions are adverse. So, how do we do that? Well, basically, if you think about, when we're in that within regime, right? Like, as we're getting up towards, the top end of the risk range, as we refer to it, or, where that call is sold, obviously, the exposure of the portfolio is being reduced just naturally because the option, that call is getting more in the money. On the flip side, when we're getting down towards that buy risk range, or, where those put strikes are, the portfolio exposure is just increasing because, those options, deltas are, the call delta is being reduced, and, the put more in the money. So, again, simply like just trying to think of maximizing the ability to participate when, conditions are optimal and minimizing them when they're adverse.
Yep. Well, what's really different here, so people understand maybe sort of in when you look at a typical sort of buffered ETF, they will do their extra trades kind of regardless. It's more of a timing thing. It's more of like on a regular schedule. What you guys are doing is you are doing it on whatever the sort of risk range is, as you guys call it, right? Which is a big deal.
Absolutely.
And that's a big, so you kind of, there's a mathematical, or I don't want to put words in you guys' mouth, however you want to define that model. I'm quite with it as well. from an investor's perspective, just to kind of look at that side for our listeners, joy is that you don't have to change a ticker all the time. Like, it's one ticker, right? And honestly, that's a pretty big deal, So
So just exactly like you just said. I mean, whereas the traditional incumbent kind of buffer hedged equity strategies, where they basically are very much just accepting what is going on in markets and deploying the strategy regardless. Basically, because we have these risk ranges, we're actually accounting for what is going on in markets, and making adjustments, whether it be explicitly through rolling the options or implicitly through the delta or the market exposure of the portfolio changing. It's really happening as a result of what is going on in markets. And again, just to get into that, how the strategy works is basically it adjusts the options positions anytime the risk range regime, as I like to refer to it as, changes. So if we go from within to above, change. So again, just trying to allow for an ability to participate when conditions are optimal, and basically minimize participation when they're adverse. How do we do that? So when we're above the top end of the risk range, we're basically writing an at the money call and buying an at the money put, which basically takes the exposure to the portfolio down to zero.
Mm-hmm.
On the flip side, when we're below that buy risk range, still want to have a level of hedging in the strategy, given there's kind of always a place for risk management portfolios. So we do still deploy a put spread, but we don't sell that call. So that obviously takes the exposure of the portfolio up and allows you to participate more in those potential, optimal conditions.
Yep.
So, and then, just given, the risk range duration. So, Keith refers to that as kind of 3 weeks. 3 weeks. So we target options that are 3 weeks out in expiration.
Mm-hmm.
So basically we're rolling at least once every 3 weeks, but obviously have the flexibility to roll as often as daily based on what's going on. So again, the whole point here is to not be stagnant. Not just sit and maintain with regards to the positions. When the markets are chopping around like they are right now, but is to actually have the ability to be be adjusting this in a systematic framework based on what is happening in markets at that time.
Now, in terms of maybe sort of the final point, but I think maybe the most important point for people in terms of the application, and when I look at buy that ETF, to me it's something like that I would put into sort of a side pocket as kind of hedging.
Yeah.
Let's say the S&P 500, which is kind of the thing, right? How do you guys view this from an application perspective? Obviously, it can be its own thing, but it can also maybe be used as hedging, an S&P 500 centric long only portfolio.
Yeah. So, I mean, we obviously had a lot of dialogues around this with different investors, and obviously first and foremost, the Hedgeye Nation, if you will, type investors or RIAs who, are really familiar with the process, really familiar with what Keith's done, really familiar with these risk ranges. The adoption there, and the conversations we've had there have obviously been, there's been a lot of them.
Sure.
So I would say, that cohort, they really are in this, as being part of core equity and, with the understanding of kind of what those risk ranges do, they kind of look at this and say, hey, I know that this can be, a core part of my equity allocation because, basically of that ability to, participate when conditions are optimal and, kind of sit on the sidelines when they're not. So they're definitely thinking about it as core equity. I would say, some folks who maybe are less familiar or, they're just getting kind of educated, on who Hedgeye is, what we do, kind of the IP backing the strategy. They look at this as kind of, you alluded to, maybe more of like a tactical allocation or something where it kind of sits in a sleeve, and maybe, hey, this helps out kind of on a rainy day, or when conditions are adverse. But I do think that cohort is still thinking about it in the equity sleeve of even that more tactical or carve out.
Yeah.
So I do think that we actually have had quite a bit of interestingly that kind of resonated with the article that came out of AQR, where clients had said to us, yeah, hey, I looked at these buffer things, but
Yep.
I really looked and said, hey, I could do this by myself, just allocating between the S&P 500
right, but then that would be the
treasuries.
hedging aspect way of looking at
Right.
this, right? Yeah, exactly.
Yeah. So and now basically those folks are utilizing this strategy because of the ability to be dynamic, and kind of that constant adjustment that don't then have to do themselves.
Yeah, sure. So you can go thank AQR for the article, because I think it speaks
to. Really funny though, because I mean, I had a conversation with one of the largest holders of the strategy before I had ever seen that article, and then I saw the article and I sent it to him, and I was like, "Did you read this?
Yeah.
Like, did you have access to this before they published it?"
Did he?
And he was like, No, of course not. He just, he making the observation, from looking at the strategies that he had available to him, and he was like, yeah, this really resonates with, with me. Really kind of the argument that I was making.
Yeah.
So,
yeah. Well, this is cool. I mean, I think, again, the whole point of the study wealth really just to educate people on different things. And I think, given the fact there's an article or 10 articles probably every day about the buffered ETFs, I just thought that I personally really the KSPY idea. I thought it would be wonderful to educate people on this a little bit. So I want to thank you for coming to the podcast.
Of course, yeah,
really
love
appreciate
doing it, and thanks for having me. Really appreciate it.
And we'll see what the market does going forward. But I think there's more than sort of a way to slice a steak, I guess. Although some people would disagree with that, actually. But I think that's kind of the point. We want to give people a different perspective. Staying hedged always a good idea, right? So I think that's kind of the bottom line here as well.
Our parent company, Hedgeye Risk Management, right name. Yeah. That's there's a point. Yeah. So obviously
very much so. We're fully on board with that whole.
We're advocates. So
absolutely, John. I much appreciate it. Thank you so much. It's John McNamara from Hedgeye Asset Management. Thanks so much, man, and hope you guys enjoyed the conversation.
Yeah, appreciate it. Thanks for having us.